Japan's story in the late 20th century is one of astonishing rise and shocking stagnation. In the 1980s, Japan was the envy of much of the world, growing fast and making iconic brands. By 1989, Japan had become the second largest economy on Earth, trailing only the United States. It felt unstoppable, factories humming, exports booming, and land prices shooting skyward. But behind the glitter, a dangerous bubble was forming in stocks and real estate. Prices rose on speculation rather than real economic growth. Banks lent freely, assuming land and stocks would only ever rise. This unsustainable optimism set the stage for disaster. When the Nikkei stock index peaked near 39,000 in December 1989, few saw danger ahead. But asset prices were detached from actual company earnings. Then the bubble began to deflate. The Bank of Japan raised interest rates repeatedly, squeezing credit. Stocks tumbled as confidence evaporated, wiping out trillions in wealth. Real estate followed. Property values collapsed across the country. By 1992, the bubble had fully burst. This collapse ushered in what would be called the lost decade. The term originally described the 1990s, but many argue Japan's stagnation continued well beyond. Growth slowed dramatically. GDP barely crept ahead, averaging around 1% per year. Deflation, where prices keep falling, became a major drag on the economy. When prices drop, people delay purchases, hoping they'll cost less tomorrow. This created a vicious cycle of low spending and slow growth. Banks were loaded with bad loans from the bubble era, hurting their ability to lend. Many lenders avoided writing off bad debts, letting unhealthy companies survive as zombie firms. This weakened the banking sector and choked off credit for healthy businesses. Even when interest rates dropped near zero, recovery was slow. Japan experienced a liquidity trap where cheap money didn't spur spending. High savings rates meant people hoarded cash instead of spending it. Japan's economy stagnated even as global markets recovered elsewhere. The deflationary period also made debt worse because the value of money kept rising. Japan's population began aging rapidly, tightening the labor force and spending power. This demographic shift has weighed on Japan's long-term growth prospects. Many young workers struggled to find stable jobs during this period, called the employment ice age. This created a lost generation with long-lasting impacts on careers and confidence. Businesses found it hard to innovate when demand was weak and credit was tight. Real estate prices, once booming, fell sharply and never fully recovered. This wiped out wealth, hurting both homeowners and financial institutions. The Nikkei index also sank and stayed low for years. Many banks had to merge or be rescued by the government. Government bailouts were expensive but necessary to prevent total collapse. Public spending on infrastructure and stimulus was used to try to revive growth. But even massive stimulus and infrastructure spending couldn't fully shake off stagnation. Japan's economy kept struggling while other Asian economies raced ahead. Japan's neighbors began to outperform it in key industries like electronics and tech. In 1998, consumer prices began falling. Japan entered a deflationary spiral. Deflation is dangerous. When prices drop, people delay buying, making the economy weaker. Even at near-zero interest rates, spending remained sluggish. Japan was stuck in a liquidity trap where monetary policy no longer worked. The Bank of Japan adopted forward guidance, promising low rates until recovery came. Japan also became the first country to use quantitative easing at scale. Quantitative easing helped some growth, but its effects were modest. When the U.S. faced recession in 2008, policymakers looked to Japan's experience for guidance. Without Japan's painful example, the global recession could have been much worse. Japan's story became a warning. Bubbles can devastate entire economies. Another long-term issue was Japan's aging population. As the workforce shrank, economic growth became even harder. Without a strong base of young workers, innovation slowed. Lifetime employment, once a Japanese hallmark, began to hold the economy back. This left fewer openings for new graduates and limited career mobility. Some younger people withdrew from society completely, becoming shut-ins. Meanwhile, older workers stayed employed, slowing labor market flexibility. This imbalance weakened productivity gains over decades. Other Asian economies, dubbed the Asian Tigers, sprinted ahead. Singapore, Hong Kong, Taiwan, and South Korea became new leaders in technology and exports. Japan's slow growth stood in contrast to the rapid strides of its neighbors. In 1998, falling prices and weak demand made Japan's slump even deeper. People saved money instead of spending it, hoping prices would fall further. This discouraged companies from investing in new projects. Innovation slowed and industry stagnated, leaving Japan behind in global trends. Japan's economic growth was no longer fast. It was often among the slowest in the developed world. Yet Japan remains a major global economy, showing resilience despite decades of struggle. Its story is a powerful lesson on bubbles, debt, demographics, and long-term economic shifts. Many nations now study Japan's lost decade to avoid similar mistakes. Today, Japan continues to innovate even as it grapples with demographic and economic challenges. And that's the story of Japan's lost decade, a tale of boom, bubble, bust, and lessons for the world.